Right, let's just talk about what has just happened in the crypto markets because yesterday was not just another red day that you scroll past and forget about. Bitcoin has dumped all the way down to 85,100. Ethereum has pulled back to around $2,850 and XRP dropped down to a low of $1.85. And the timing of this move is not random. So the big question everybody is talking about right now is this: has the market already priced in the Japan interest rate hike? Or was yesterday's sell-off just the first reaction, with more volatility still to come? And if that's true, this could be painful. Because if you understand why this move happened, instead of just reacting emotionally to red candles, you put yourself in a much stronger position than most people in crypto will be in. Before we break this down properly, a quick thank you to Tangent for sponsoring today's video. With the level of volatility that we're seeing right now, it's more important than ever to think about self-custody for your crypto. If your crypto is sitting on an exchange, you don't truly control it. Not your keys, not your crypto. And a cold storage wallet puts you in control of your private keys, not a third party like an exchange. One of the wallets that I personally use and recommend is Tangent. It's simple, beginner friendly, and doesn't rely on writing down seed phrases that can be lost or compromised. If you're holding Bitcoin, XRP, Ethereum long term, a cold wallet is just part of managing your risk properly. Tangent have given us a 10% discount code. There's a link in the description. Or you can go to the Tangent website and use the promo code MilkshakeMatty at checkout and get 10% off. And remember, you can stack promo codes. So if Tangent have any seasonal offers running, my code can be used on top of that for another 10% off. Right, let's get into the markets. Yesterday, we saw a sharp, aggressive pullback across the entire crypto market. Bitcoin sold off hard, tagging in a low of around 85,100 before starting to stabilize this morning. And Ethereum followed. It pulled back roughly to around $2,850. And XRP, which had been holding relatively well during these times, has dipped to around $1.85. Now, here's the important part. This wasn't a slow bleed. This wasn't social media panic. This wasn't retail reacting to some random headline. This was a decisive, correlated move across multiple assets. When Bitcoin, Ethereum, and XRP all sell off together like that, it usually means one thing: macro forces are at work. And that's the context most people miss. Instead of asking why is XRP down or why did Bitcoin dump, the better question is this: what changed at the macro level that forced risk off the table? And right now, one answer stands out above everything else, and that is Japan. If you've been watching me for some time, watching the Milkshake Matty channel over on TikTok or here on YouTube, you'll know that I've been talking about this Japan issue way before the summer. This was something that I saw coming and something I was genuinely worried about. And while the haters in the comments said Japan interest rates have absolutely nothing to do with my crypto bags prices, I think today could have proven me right. A lot of people massively underestimate Japan's importance in global markets, but Japan plays a huge role in global liquidity. For decades, Japan has operated under ultra low interest rates, sometimes even negative rates, which I know sounds wild for any of us here in the West, but it happened. It's just the way Japan structures its finance that made the Japan's yen one of the cheapest currencies in the world to borrow. And that created what's called the yen carry trade. Here's how that works in simple terms. Institutions borrow the yen at extremely low interest. They then convert it into dollars or the Great British Pound. Then they invest that money into higher risk, higher return assets. That includes stocks, tech, emerging markets, and yes, indeed, crypto. When Japan keeps rates low, global liquidity stays loose, which is a good thing. When Japan starts raising rates, that cheap money begins to disappear. And when that happens, leverage gets reduced, positions get unwound, and risk assets get sold. That's why crypto reacts to Japanese monetary policy, even if you've never traded Forex in your life. This is not just any rate hike. The Bank of Japan is moving towards interest rate levels not seen in roughly 30 years. That's not a small amount of adjustment. That's a structural shift. And markets don't wait for confirmation. Markets anticipate. Funds reposition ahead of time, leverage is reduced early, and risk is taken off before the headline hits. That's why the timing of yesterday's dump matters so much. This sell-off didn't come out of nowhere. It came ahead of a widely expected macro shift, which brings us to the key question. Has the market already priced this in? The answer is not a simple yes or no. It's yes partially and no, not fully. Let's break that down. why some of it is priced in, because markets hate uncertainty. And right now, there is very little uncertainty around Japan's direction. The probability of a rate hike is extremely high. Institutional traders know this, funds know this. So, what can they do? They reduce risk ahead of time. That means cutting leverage, trimming exposure, and locking in profits. That kind of behavior fits perfectly with what we saw yesterday, following into the early hours of this morning. A fast, correlated sell off across Bitcoin, Ethereum, XRP, and other assets that strongly suggests anticipation selling. So, why may it not be fully priced in? But macro events don't usually revolve in one single move. They happen in phases. Phase one is anticipation, phase two is confirmation, and phase three is secondary effects. Even if the rate hike itself is expected, what really matters is this: the tone from the Bank of Japan and forward guidance, whether this is a one off move or the start of a tightening cycle. If markets sense that Japan is serious about sustained tightening, there could still be more volatility ahead. So while some of this move is likely priced in, that doesn't mean the reaction is fully over yet. So why did Bitcoin, Ethereum, and XRP all move together, almost identical charts overnight? Let's talk about the correlation, because this is important. Bitcoin dropped to 85,100. Ethereum pulled back to 2,850 and XRP dipped to $1.85. That tells you everything that you need to know. This was not an XRP narrative issue. This was not an Ethereum problem. This was not a Bitcoin fundamentals breaking. This was risk off behavior. When macro pressure hits, correlations go to one. Liquidity exits everything. That's exactly what yesterday looked like. And scenario two is further volatility. If the Bank of Japan surprises the markets with more hawkish language, we could see another leg of volatility. I know you don't want to hear this, guys, but we need to be honest here on this channel. We're not necessarily going to see a crash, but a continued pressure. This is why patience matters. This is why position sizing matters. This is why emotional trading destroys accounts. Macro-driven pullbacks are not the same as trend reversals. They are part of how markets adjust to new information. Smart money does not panic here. Smart money plans entries, manages risks, and looks at liquidity, not headlines. If you're investing or trading with a longer term plan, moments like this are information, not fear signals. So let's close this out clearly. Has the market already priced in the Japan interest rate hike? Some of it, yes, I think so. All of it? I've got to be honest, probably not. I think we might have some more pain ahead. Yesterday's move for Bitcoin, Ethereum, and XRP was macro driven, not random. And understanding why this happened puts you ahead of most people in this space. Now, I want to hear from you. Do you think the worst is behind us? Do you think this was just the first reaction? Have we got more pain ahead, or was that it and we're done and we're about to bounce and go to the moon? Let me know in the comments exactly what you think. So if this video helped you understand the why, not just the what, hit that like button, subscribe if you're new, and I'll be seeing you on the next one. And remember this: the strength of the wolf is in the pack. I am not a financial advisor. This video is based solely on my opinion on what I am personally doing in this market. I also want to let you know that some of the links below and in the descriptions are affiliate links, meaning I may get a commission, but it will be at no extra cost to you. Please remember that under no circumstances will I ever contact you and ask you for investments. You can confirm all of my real social media handles in the description and also at milkshakematty.com. This content is for educational and entertainment only, and I am not a financial advisor.